You paid for gap insurance, you did everything right. And when your car was totaled, through absolutely no fault of your own, that gap coverage did almost nothing. Not because of a loophole you missed, not because of fine print buried on page 40, but because of a single clause that the dealership never explained, that works directly against you, and that is completely legal in most states. This is that story, and by the end, you'll know exactly how to make sure it never happens to you. Picture this. You're driving, minding your own business, and another driver causes a crash that destroys your car. Police report confirms it, insurance confirms it, total loss. You think, okay, this is bad, but I have gap insurance. I bought it specifically for this moment. I'm covered. And then the numbers start coming in, and you realize something is very, very wrong. Let's set the scene before we get into the details, because context matters here. Gap insurance, which stands for Guaranteed Asset Protection, exists for one reason. When you buy a car and finance it, you often owe more on the loan than the car is actually worth. Cars depreciate fast, especially in the first year or two. So if your car gets totaled, your regular auto insurance only pays you what the car is worth on that day, not what you owe. If those two numbers don't match, you're left paying a loan on a car that no longer exists. Gap insurance is supposed to cover that difference. That's the entire pitch. That's what you're buying. Millions of people buy gap coverage every year. It's sold at dealerships constantly, often rolled right into the financing paperwork during the hours-long process of buying a car when you're mentally exhausted and just want to drive home. It sounds like a smart, responsible purchase. For a lot of people, genuinely is. But as one driver in Florida recently discovered, not all gap policies are created equal, and the differences can cost you thousands of dollars when you need help the most. So here's what happened. A driver, we'll call them the car owner, got into an accident that was 100% the other driver's fault. Their car was declared a total loss. Clear-cut situation, right? Wrong. Their insurance company, using a third-party valuation tool, assessed the car's actual cash value at around $23,100. After accounting for their deductible and a small prior damage deduction, the insurance payout came to approximately $23,600. The original loan balance was about $26,900. That leaves a gap, the actual gap, of roughly $3,300 still owed on a car that no longer exists. This is exactly what gap insurance is for. But here's where the story takes a turn. The car owner had purchased gap coverage through the dealership at signing. The product was administered by a company called Total Warranty Services, a dealer-sold gap product. And buried in that contract was a clause that most people would never think to read, let alone understand. The contract defined actual cash value, the ACV, not as whatever the insurance company paid, but as the NADA value, the National Automobile Dealers Association value, and it specified that GAP would use the greater of the insurance payout or the NADA value. Now here's why that matters. NADA valued the same car on the same date of loss at $26,300. That's $3,200 more than what Progressive actually paid out. Two different numbers for the exact same car on the exact same day. Because the GAP contract used the higher number, the NADA value, the math completely changed. The GAP administrator looked at a loan balance of $26,900 and an ACV of $26,300 and said, "Your GAP is only $627. But it gets worse. The GAP policy itself had an unearned premium refund, essentially a cancellation refund built into the contract worth about $1,131. Standard stuff. When a car is totaled, any unused portion of the GAP premium gets refunded to the lien holder. Here's the problem. That refund amount was larger than the calculated GAP amount, $1,100 versus $627. So the GAP administrator closed the claim entirely. They said, "The refund covers your GAP, here's the remainder, we're done." And they sent the refund check directly to the car owner's credit union, the lien holder. The car owner was left still owing approximately $2,174 on a vehicle they no longer had. They had paid $1,500 for GAP insurance, and the insurance on the at-fault driver, the person who actually caused all of this, was minimum coverage. The car owner also had no uninsured or underinsured motorist coverage of their own. Every door that might have led to full coverage was either closed or too small to fit through. Let that sink in for a moment. $1,500 spent on gap insurance, a total loss caused by someone else, and still over $2,000 owed on a car sitting in a salvage yard. The car owner started doing research, and what they found made everything even more frustrating. Most gap policies, the kind you'd buy through your actual insurance company, calculate the gap simply: what you owe minus what insurance pays. Clean, straightforward, the way Gap is literally marketed to consumers. But this dealer-sold product had a greater of clause that allowed the administrator to substitute a higher valuation number, NADA, in place of the actual insurance settlement. This clause effectively shrank the visible gap and allowed the refund to cancel it out entirely. Was this clause disclosed at signing? According to the car owner, no. Was it explained? No. Would a reasonable person purchasing gap insurance understand that this clause could be used against them in exactly this way? Almost certainly not. Most people buying Gap at a dealership have been sitting in a finance office for hours. They're handed a stack of documents. They're told this protects them. They sign. The car owner took action. They filed a complaint with the Florida Department of Financial Services against the Gap administrator. They emailed the dealership manager. They contacted Total Warranty Services directly, and they reached out to their bank to see if anything could be done from that end. Their expectation was realistic, probably no money back, but they wanted a paper trail. They wanted accountability. They wanted the complaint to exist somewhere on record so that maybe, just maybe, someone else's claim would be handled differently. And here's something worth noting. The car owner also pushed back on the Progressive valuation itself. Progressive, like many insurers, uses third-party tools, in this case Mitchell and J.D. Power, to calculate actual cash value. These tools are known to sometimes produce valuations that are lower than market reality. If you believe your car was undervalued, you do have the right to dispute it. You can gather comparable listings in your area, same make, model, year, trim, mileage, and present them to your insurer as evidence. This process works. It doesn't always work quickly, but disputing an ACV valuation is a legitimate step that many people don't know they can take. And in some states, you're entitled to formal appraisal processes if you can't agree on a number. The car owner had already signed the settlement paperwork by the time they realized how much this was going to cost them, which complicated the dispute. Signing that paperwork can, depending on its language, be treated as accepting the settlement. If you're ever in a total loss situation, do not sign anything until you've reviewed the valuation carefully and decided whether you want to dispute it. That window matters. So, what do you actually take away from all of this? A few things. First, never buy gap insurance from the dealership if you can avoid it. Buy it through your actual auto insurance company. It's almost always cheaper, it's regulated more consistently, and the payout calculation is typically straightforward. The dealer-sold products are often administered by third-party companies with more complex contract language that can work against you in exactly the way this story shows. Second, if you already have dealer gap, read the contract right now. Look for phrases like greater of, look for how ACV is defined, and look for how the unearned premium refund interacts with your gap calculation. You want to understand this before you need it. Third, always carry uninsured and underinsured motorist coverage on your own policy. The other driver being at fault means nothing if they only have minimum coverage and your losses exceed it. UIM coverage is one of the most important and most overlooked protections you can buy. Fourth, if your car is ever totaled, do not accept the first ACV number without question. Research comparable vehicles in your area. Build a case. Push back. Insurers expect some negotiation, and a documented counteroffer often moves the number. And fifth, if a gap claim is ever closed or denied in a way that seems wrong, file a complaint with your state's Department of Financial Services or insurance commissioner. It may not get your money back immediately, but it creates a record, and regulators do look at patterns of complaints when deciding whether to investigate companies. The car owner in this story is out over $2,000 on top of everything else they went through after an accident that wasn't their fault. They did what they were supposed to do. They bought the coverage. They thought they were protected. The system let them down, not through outright fraud, but through a clause that was never explained and a product that was sold with one implied promise while delivering something much narrower. If this happened to you, if you're sitting on a total loss claim right now and the numbers aren't adding up, start with your state insurance commissioner. File the complaint. Document everything. Don't assume the first answer you get is the final answer. And if you've learned something today, stick around. We cover stories like this every week. Real situations where the fine print matters, and knowing the rules can be the difference between getting what you're owed and absorbing a loss that should never have been yours to carry. Subscribe so you don't miss the next one.